welcome back to Fast Stock Market News, where I give you all the news as fast as I can. So today, guys, was a very much expected, pretty rocky day in the stock market. We have two big things that are weighing us down lower right now, and one of them we're already kind of like, the market is basically already mentally prepared for the numbers that are happening right now, and that's inflation. If you guys are not aware, the CPI data comes up later this week, which will basically show what is our latest inflation numbers. And the other thing that's weighing down the market, which it's starting to, a lot of analysts are starting to adjust their numbers, lower expectations and guidance for a lot of these companies. But it hasn't the market hasn't completely priced in an absolutely catastrophic miss of earnings from a lot of the companies that will be reporting, especially this week. But before we get to that, let's just see how the indexes did. And we can see the S&P 500 finished a negative 1.15% in the red. You see the Dow finishing negative 0.52% in the red. The NASDAQ having a very bumpy day, finishing negative 2.26 in the red. And Russell 2000 finishing negative 2.11% in the red. So basically the thing that's driving down the market right now is basically the economic data, which is the CPI and earnings. If you guys see right here, as far as the CPI goes, we're going to actually get the numbers on Wednesday around 5:30 a.m. Pacific Standard Time. The CPI will come out, and that's going to be causing the market to dump a lot or skyrocket, depending on how hot the inflation is. Currently, as it stands, that's something that we've already, the market's slowly starting to price in the inflation data. It's considered that it's going to be around 9%, and it's something that's kind of expected right now. But as you can see, the CPI is basically around 8.8%. So the other thing that's actually being that hasn't completely been priced in by the markets, especially, is earnings. And the biggest companies that will be reporting earnings this week will be the banks. The banks always kick off earnings season, guys. No matter what quarter it is, banks always set the tone for the rest of the market. And the biggest banks that will be reporting are JP Morgan, Morgan Stanley on Thursday, and we'll have Wells Fargo and Citigroup on Friday. And these will be a very telling sign of what we will be expecting the rest of the way, guys. Because right now, we at this point, we pretty much the market has been fatigued with the inflation data, the Fed tightening, the geopolitical issues, but something the market hasn't completely priced in is basically bad misses in this upcoming quarter from all kinds of companies, not only banks, but also big tech companies. So that's something to be on the lookout. And to reiterate this point, there's a gentleman that came out on CNBC that basically sees it the exact same way. Take a look.
All right, Hugh, what's your latest thinking on the market?
Well, my thinking is a little bit more positive than you'll hear from most people. This is a tough one. I think, Kelly, the one thing that you should sort of keep in the back of your mind is often when we go through these corrections, and we did in 2011 and 2018, 2014, something very much in common. What you do is you get to an emotional extreme. That's a sort of a marketed phenomena. And really what I'm saying is that the markets get pretty undervalued. Everybody does the numbers differently. That's where I come down. It's very undervalued given assumptions about earnings. And the second thing is you get widespread pessimism, and that's an emotional extreme. And ordinarily that's followed by, not always, but followed by a move up in stocks. It doesn't come right away, but it comes over time. The average annual rate of return for the market when you get to emotional extremes of this magnitude is about 18% over a 6-month period. Cross your fingers on that one. So I have to say, with that in mind, I have to remain positive. But a lot of this includes assumptions about what's going to happen to earnings. I'm fine on interest rates. I'm fine on everything. But the real key right now going forward, the shift is going to be a focus on earnings.
And I'm so glad that you said that, because obviously this week we kick things off. We hear from JP Morgan on Thursday. So you think the market is clearly undervalued because of your view on earnings. So you think the estimates are going to be fine? They're not going to come down from here? We're not going to have a big sort of, revaluation on that front?
Yeah. Kelly, you asked the right question, and I wish I had the right answer. I don't know what's going to happen, but I will say this, is that, and going back to some of the things you were talking to Steve about, if I use my assumption on what the economy is going to do in 2022, the later part of 2022 and 23, it carries with it an implication that those earnings are going to hold up. In other words, we're talking about roughly say 9% this year, maybe 8% next year. Those kinds of growth rates and earnings, and they're going to hold together so long as our outlook or forecast for the economy holds together. So I think everything's fine now, but believe me, it is very tough, Kelly, as you well know, to keep optimistic about earnings.
Well, yeah, guys, you can see that's basically what's driving the market right now. You can expect most likely another volatile day tomorrow in the stock market. It's going to be volatile probably for the rest of the week until we get through these earnings as well as the CPI data. But yeah, guys, thanks again for watching my video, and I'll see you again tomorrow. Take care, everyone. Thanks again, everyone, for watching Fast Stock Market News. If you enjoyed the video, consider subscribing, commenting, or liking the video. I would greatly appreciate it. My name is Gio, and I'll see you tomorrow, guys. Take care.